In Forex trading, economic data drives currency movements. Among the most important indicators are GDP, CPI, and interest rates. Understanding them can give you an edge in predicting market direction. Let's break each one down. First, GDP, gross domestic product. GDP measures the total value of goods and services produced in a country over a period. It's a snapshot of economic health. A strong GDP means the economy is growing, businesses are thriving, and consumers are spending. This usually strengthens the currency because investors are attracted to a growing economy. A weak GDP shows slow growth or contraction, often leading to currency weakness. In Forex, watching GDP announcements helps traders anticipate long-term trends rather than short-term spikes. Second, CPI, Consumer Price Index. CPI measures inflation, how much prices for goods and services change over time. Central banks and traders watch CPI closely because inflation affects monetary policy. High inflation may lead central banks to raise interest rates, making a currency more attractive. Low inflation can lead to rate cuts, weakening the currency. For example, if the US CPI comes in hotter than expected, the US dollar often strengthens as traders anticipate Fed action. Third, interest rates. Interest rates set by central banks are among the most powerful drivers of Forex. Higher rates offer better returns on investments in that currency, attracting global capital and strengthening the currency. Lower rates make borrowing cheaper, but reduce returns for investors, often weakening the currency. Interest rate changes also impact expectations. Even rumors of a rate hike can move markets. Fourth, how traders use these indicators. Compare GDP growth rates between countries to identify stronger currencies. Monitor CPI trends to anticipate inflation pressures and central bank responses. Watch interest rate announcements for immediate currency impact. Combining these three indicators helps traders make informed decisions rather than relying on guesswork. In summary, GDP tells you the health of the economy. CPI shows inflation trends. Interest rates drive capital flows and currency strength. Together, these indicators form the backbone of fundamental analysis in Forex. Traders who understand them can anticipate market moves, manage risk, and trade with confidence, because knowledge is your most powerful tool in the Forex market.